It's important to note that while the stock market and the overall economy are closely connected, they are not synonymous. Nevertheless, it's natural for people to feel concerned when one of these indicators isn't performing as expected, given the potential repercussions on the other. Global stock markets hold trillions of dollars in investments, representing countless companies that collectively employ billions of individuals. When these companies face challenges, it directly affects the portfolios of investors, potentially putting millions of jobs at risk. This can initiate a detrimental cycle where job losses lead to reduced spending, further impacting these companies. Additionally, the health of an economy profoundly influences the performance of companies listed on exchanges worldwide. Economic well-being is often gauged by gross domestic product, GDP, which reflects the total output of an economy. When an economy experiences a downturn, it's indicative of industries struggling, many of which are driven by companies in advanced economies across the globe. With this fundamental understanding, it can be puzzling when economists assert that the stock market and the economy are distinct entities, with no particularly strong correlation between them. This assertion gains even more significance when prominent, successful investors make high-profile investments based on their predictions about the future of the economy. After all, these investors didn't amass their wealth by making erroneous decisions. So, this leaves us pondering whether economists might be in error, and if the evident connection between the economy and the markets holds true. In light of this, it's essential to delve deeper into why an increasing number of influential investors are placing bets against the U.S. economy in particular. By most key indicators, the United States, and indeed many advanced economies worldwide, are currently in a period of substantial growth. While a significant portion of this growth is recuperating from the economic downturn caused by the global pandemic, the world's overall wealth is at an all-time high. So, which perspective is accurate? Can the economy provide insights into stock market movements, or is it the other way around? If there is a connection, what do the indicators reveal at this moment? And if they're fundamentally disconnected, how can two markets that appear to share so much in common truly be distinct? While we explore the intricacies of economic predictions, it's vital to remember that all these figures and data points represent real people with real lives. Even if you're fortunate enough to maintain job security and a stable pension, we all encounter our fair share of life's challenges. In times of uncertainty, it's common to feel overwhelmed and adrift amid the ever-changing world. It's precisely these moments that present opportunities to break free from our routines and create a life we can take pride in. Finding correlations between different sets of economic data is the essence of econometrics. Econometrics entails using statistical methods in conjunction with economic knowledge to provide valuable insights for decision-makers in the economic field. Even individuals with a basic grasp of supply and demand understand that all other factors held constant, an increase in the money supply generally leads to an increase in inflation. Economists specializing in econometrics take this foundational understanding and gather data on key economic variables such as the money supply, interest rates, the consumer price index, employment figures, and overall economic output to either validate or disprove these relationships. Even more crucially, they strive to quantify these relationships, offering valuable insights to institutions like central banks. These institutions can ascertain not only that an increase in the money supply affects inflation, but also the extent of that impact. For instance, they might conclude that a 10% rise in the money supply, under specific conditions like a 5% unemployment rate and a 2% annual output growth, is likely to lead to a certain level of inflation within 12 months. It's important to remember that predicting the future remains an unpredictable endeavor, especially for economists. However, by examining past data and unraveling the nature and strength of the relationship between economic objectives and the tools at their disposal, economists provide the best possible guidance. Economists don't dictate inflation, but they wield influence over interest rates and the money supply, much like how a driver doesn't control their car's speed, but they do regulate it by adjusting the accelerator pedal. Other variables often intervene between the desired outcome and the mechanism by which it's achieved. To draw a parallel with our car example, there's typically a strong correlation between the pressure on the accelerator pedal and the vehicle's speed, but it's not flawless. Other statistically significant factors, such as the car's gear, weight, road conditions, and whether it's operational, must also be considered. Prudent feedback is essential to ensure the results align with expectations. In a car, this feedback comes through the dashboard. Similarly, for an economy, this feedback is provided by individuals employing econometrics to gather and make sense of data. In comparison, uncovering the correlation between a well-documented index like the S&P 500, which tracks the 500 largest U.S. companies, and the GDP of the United States, is remarkably straightforward. Naturally, with a concept this simple that holds the potential for significant financial gains, economists have conducted various regression analyses in numerous ways. Some studies sought to determine whether there was a time lag in the correlation, questioning if a GDP decline 1 year might influence the stock market 6 months or a year later. Others probed to discover whether there was a one-sided relationship, where perhaps a robust economy only propelled the stock market, while it remained indifferent to economic downturns, or the reverse scenario. Virtually every conceivable relationship between these two data sets has been extensively examined over time. All of these studies arrived at a unanimous conclusion. There is no significant short or medium-term correlation between the two factors. Year by year, the economy's performance only explains approximately 7% to 11% of the stock market's growth or contraction. This degree of correlation is typically of minimal concern to most statisticians. The reason lies in the fundamental difference in purpose. Economic metrics, such as total output, are designed to guide economic decision-makers on what actions to take, while the stock market's value is forward-looking. It's predicated on investors' expectations of returns and their financial clout. The clearest illustration of this divergence is the world's experience during the peak of the global pandemic just 2 years ago. In the United States, home to the largest economy and stock markets globally, economic indicators were gloomy. High unemployment rates, disrupted supply chains, and growing inflation were significant concerns. Yet paradoxically, stock markets worldwide were setting record highs. A year later, as unemployment rates reached a long-term equilibrium, inflation stabilized, and goods returned to store shelves, the S&P 500 saw a 20% decline, with smaller company indexes performing even worse. Undoubtedly, these were exceptional circumstances, but paradoxically, these are the times when one might expect both these data points to move in harmony. On a typical day, various forces operate to push the stock market and the economy in opposite directions. For instance, a high level of consumer debt might benefit companies selling consumer goods or providing consumer credit, yet it exerts a constraining influence on economic growth, but primarily in the short to medium term. To add to the complexity, in the long term, a correlation between these two data points emerges, which is entirely logical. Companies serve as the principal engines of economic output, and the sole way for their values to rise over time is by increasing that output, ultimately expanding the size of the economy, assuming all other factors remain equal. Conversely, businesses can only grow to a certain extent if they have customers to purchase their goods and services. Consequently, a stagnant or shrinking economy will ultimately translate to a stagnant stock market, provided the constituent companies cannot expand their operations beyond national borders. Japan serves as a clear example of this phenomenon. Despite its status as the world's third-largest economy and home to a plethora of globally renowned companies, its economy has remained stagnant for over 3 decades, and correspondingly, the stock market has exhibited a similar trend. In contrast, consider the United States, which has experienced robust growth during the same period, with the public companies represented in its stock markets also expanding. While not a perfect analogy, it can be helpful to view the relationship between a country's GDP and its stock market as somewhat akin to the connection between an individual's income and the value of their home. Year by year, the value of their home may fluctuate independently of their income, driven by market dynamics. Simultaneously, should that individual lose their job, it doesn't immediately reduce the value of their home to zero. In fact, it could even appreciate in value as they invest time and resources into improving their property. The comparison here is with emergency measures, such as manipulating interest rates and providing stimulus packages to bail out struggling companies. It's essential to recognize that some individuals enjoy substantial incomes, but may not necessarily aspire to own a large, expensive house. Throughout this video, we've primarily focused on the United States, which boasts the world's largest stock markets by a considerable margin. In contrast, consider a country like China, which, in terms of economic output, matches the USA but maintains a considerably smaller stock market due to a preference among its investors for real estate investments. China tends to be a less attractive destination for foreign investors, with fewer companies attaining the colossal scale of those in the USA. In fact, the market value of U.S. company stock stands as somewhat of an anomaly when compared to other Western advanced economies globally. To put this into perspective, the worth of a single U.S. company such as Apple surpasses the combined value of every company listed on all the stock exchanges here in Australia, a substantial economy in its own right, and one that's notably business-friendly, as we'll delve into shortly. The vast size of the U.S. stock market can be likened to someone with a very high income who is invested in an exceedingly expensive house. Nevertheless, over the long term, the expectation remains that a higher income or an increase in annual economic output will eventually result in purchasing a more valuable home or having a more substantial stock market, respectively. If this still seems perplexing, there's no need to fret. Notable figures in economics, like John Maynard Keynes, often considered one of the most famous and influential economists of all time, attempted to utilize their insights into the business cycle to profit in the stock and currency markets. In the initial years of this endeavor, Keynes experienced substantial losses and even risked bankruptcy. This serves as a testament to the difficulty even brilliant minds face when trying to predict economic cycles. And even when they do make accurate predictions, the correlation with investment markets remains weak at best. As historical accounts indicate, Keynes eventually evolved into an above-average investor, but this transformation only occurred after he abandoned the strategy of an economist trying to foresee the future. It appears that predicting the future is not a domain where economists excel. So, with all of that in mind, what's the significance when people discuss major investors betting against the economy? The stock market isn't the sole investment market for speculation. Investors can also turn to assets like bonds. When an investor foresees an economic downturn, they might adopt a strategy of selling short-term bonds and purchasing long-term ones. Bonds are essentially loans, their value contingent on the principal amount, the interest rate they carry, and the risk associated with repayment. Bonds can be issued by companies looking to raise capital, serving as an alternative to selling shares or securing bank loans. They can also be issued by governments. Government bonds are generally considered safer, especially in advanced economies where bonds are denominated in the government's own currency. In such cases, governments can potentially repay these bonds by increasing the money supply if necessary. Typically, when an economy faces a downturn, the central bank responds by reducing interest rates in an attempt to stimulate consumer spending. This translates to lower loan payments, which leaves individuals with more money to allocate toward consumption and investment, the two key drivers of economic output. It also makes saving more enticing, motivating economic participants to direct their funds into spending or alternative investments, rather than letting money sit idle. In the grand scheme of things, these actions ideally help offset the decline in investment and spending that typically accompanies job losses and diminishing confidence during an economic downturn. However, it's worth noting that lower interest rates can negatively impact individuals who rely on income from interest-bearing assets. To counteract this, some opt to invest in long-term bonds with interest rates established before the rate cuts, seeking a more stable return. When interest rates change, the dynamics of bond values come into play. If an older bond pays a 5% interest rate and a new bond pays a reduced 2% rate due to the lower rates, the value of the older bond will increase because it delivers more substantial returns. Let's consider both bonds as loans for $1,000 each. The older bond yields $50 annually, while the new bond yields just $20 annually. If someone desires a more significant return and isn't content with earning $20 a year, They can approach someone holding the older bond and propose to buy it for $2,000. The older bond still delivers $50 a year in interest, which, for the buyer, equates to an effective interest rate of 2.5%, surpassing what they could earn by purchasing a new bond. In this scenario, the seller of the older bond gains $1,000 in profit in a relatively short period, while the buyer secures a slightly better return. In essence, it's a win-win situation. However, it's essential to recognize that bond pricing is more intricate than this simplified example suggests. In reality, this illustration assumes that bonds never mature, but the core principles remain applicable. People who are betting against the economy can leverage these dynamics by purchasing bonds with higher interest rates before anticipating a drop in rates, and then selling them to profit if rates indeed decline. Typically, shorter-term bonds tend to hold more value relative to their interest rates than longer-term bonds. This is primarily due to the fact that, unlike a savings account, once money is invested in a bond, it's essentially locked away until that bond matures. Committing funds for a 10-year period carries more risk than locking them away for just 1 year, because the individual purchasing that bond may require access to their investment before the bond's maturity. However, there's a notable exception to this rule. It occurs when a substantial number of investors anticipate a decline in interest rates. In such cases, they seek to acquire long-term bonds, securing higher interest rates for an extended period before rates potentially drop. When long-term bonds become relatively more valuable than short-term bonds, it's referred to as an inverted yield curve. Economists and analysts tend to express deep concern when this occurs, because it essentially signifies that people are casting their financial votes, indicating a belief that the future economic outlook appears dimmer than the present one. In the real world, speculators engage in making speculative guesses about the future all the time. If they happen to be correct, they reap profits. If they're mistaken, they face losses. That's essentially the nature of their endeavors. It's what they do. Currently, the yield curve is inverted, but this primarily reflects the general expectation that interest rates will decline from their present levels. The reason for this expectation is that interest rates were raised significantly higher than usual to combat inflation. In this context, falling interest rates signify a return to a more standard state rather than an emergency measure to stimulate the economy. Factors like the appreciating value of the US dollar and the euro demonstrate that most investors maintain a high level of confidence in major, established economies. At the very least, this confidence appears to surpass their confidence in many other global economies. If there's one notable cause for concern, it's the United States, which has historically held a substantial ratio of company value to economic output. Presently, it's pushing this ratio to an extreme. Historically, the combined worth of all publicly traded U.S. companies has accounted for around 80% of GDP. Today, that ratio exceeds this historical benchmark and is inching close to the all-time high, previously established during the peak of the pandemic. In the short term, these two factors may not appear correlated, but over the long term, one of several things will likely happen. The economy will need to expand to align with the elevated company valuations. The values of these firms will have to decline, or this situation may become the new norm. Predicting which path it will take isn't within the purview of an economist, but Warren Buffett, arguably one of the most influential investors in history, often scrutinizes this ratio. He maintains that anything exceeding 120% suggests that the market is overvalued. The key takeaway here, if nothing else, is that the economy and investment markets adhere to two distinct sets of rules. Most individuals grapple with making accurate forecasts in either domain, let alone trying to navigate both concurrently. Thanks for watching. Bye.